My name is Carolyn Olson, and I'm certified in long-term care and also partnership certified. And that's what I'm talking to you about today, long-term care partnership policies. Major improvements were made to long-term care insurance through federal legislation in 1996 and 2005. The older traditional long-term care insurance policies were good, but the newer long-term care partnership policies are even better. To help you understand why these newer partnership policies are better than the older traditional policies, we must first make sure you understand how long-term care is paid for in this country. What pays for long-term care and what does not pay for long-term care? Every year, the federal government publishes the Medicare and You Handbook, and they list what Medicare does not pay for. Most people think that Medicare pays for long-term care. It does not. It clearly states that long-term care is not covered by Medicare. Medicare and most health insurance, including Medicare supplement insurance, don't pay for this type of care. The handbook explains how to pay for long-term care. It reads, long-term care, sometimes called long-term services and supports, includes non-medical care for people who have a chronic illness or disability. This includes non-skilled personal care assistance, like help with everyday activities, including dressing, bathing, and using the bathroom. Non-medical care also includes home-delivered meals, adult day health care, and other services. Medicare and most health insurance, including Medicare supplement insurance, don't pay for this type of care. You may be eligible for this care through Medicaid. You can use your own money, or you could choose to buy private long-term care insurance. Why do so many people think that Medicare pays for long-term care? There are two reasons. Medicare pays for rehabilitative care, not personal care. Medicare pays for rehabilitative care for up to 100 days in a skilled nursing facility. Medicare pays for rehabilitative care at home with no limit as long as you continue to improve. Medicaid pays for long-term care for those who financially qualify. Many people confuse Medicaid with Medicare. Medicaid is only for those who have assets and income low enough to qualify for the program. In most states, in order to qualify for Medicaid, you must spend your assets on your care until you have only $2,000. After you have spent down your assets, then Medicaid will start to pay for your care. And this is what most people do. Most people do this out of ignorance, not on purpose. Most people don't realize that Medicare does not pay for long-term care because they confuse Medicare and Medicaid. And they don't realize that in order for Medicaid to pay for your care, you've got to first spend your assets down to about $2,000. Let's look at three different scenarios. 1, most people spend down assets then go on Medicaid. 2, some people buy long-term care insurance, use their assets as needed. If they need a lot of care and they exhaust the long-term care insurance policy's benefits, they may end up spending all of their assets down and then go on Medicaid. And 3, a few people have learned about long-term care partnership policies. These policies can protect your assets from Medicaid so that you do not have to spend down your assets, even if your policy runs out of benefits. Let's use my mom as an example. My mom needed care for over 4 years, and using her as an example, I'll help you understand the differences between Medicaid, traditional long-term care insurance, and long-term care partnership policies. Here's a picture of my mom and me about 20 years ago. She and my dad worked very hard to provide for my brothers and me. My mom was a bookkeeper for a charity. My dad was an officer in the military, and then he became a property manager. They saved and invested and were able to retire comfortably. But my mom's health declined. In 2017, I was on a business trip and I got a call from my brother that my mom was in the hospital. She had a series of brain bleeds and her cognitive abilities were impaired, and she had trouble balancing. Once out of the hospital, and for safety reasons, she needed somebody nearby while bathing and dressing every day. She needed long-term care. Here's a picture of my mom with one of her home health aides. Medicare doesn't pay for long-term care. We know that from the Medicare and You Handbook. My parents had saved too much money to qualify for Medicaid. In order to qualify for Medicaid, she would need to spend down their assets. They didn't want to spend down their assets. They wanted to have a comfortable retirement, and they also wanted to leave a legacy to me and my brothers. Fortunately, many years before, when she was still healthy, my mother purchased a traditional long-term care insurance policy. Long-term care insurance must be purchased before care is needed. You must be healthy enough to qualify for the policy. My mom was not in perfect health when she purchased her policy. She was overweight, she had diabetes and high blood pressure, but they were well controlled. Her health wasn't great, but it was good enough to be approved for a policy. My dad wasn't. He had had a stroke and a heart valve replacement, and he was not able to qualify for a policy. When my mom needed care, we activated her long-term care insurance policy. Instead of having to spend down their savings, her long-term care insurance policy covered nearly the entire cost of her care at home, as well as the 3 years she lived in an assisted living facility. She never had to go to a nursing home. Her assets were protected, and she and my dad left a legacy to their 3 children, which was something that was very important to them. Now, her policy had about $375,000 of benefits in it. She used about $275,000 of it before she passed away. But what if she had used all of the benefits in her traditional long-term care insurance policy? What if she had used up all $375,000 of benefits? How would her care have been paid for after that? She would have had starts to spend down her savings, and if she had spent it all down to $2,000, she would have had to go on Medicaid. Fortunately, there's a new type of long-term care insurance that is even better than what my mom had. It's called a long-term care partnership policy. A long-term care partnership policy can protect your assets from Medicaid even if your policy runs out of benefits. In other words, for someone who owns a long-term care partnership policy, the Medicaid rules change for that person. Instead of having to spend your assets down to $2,000, someone with a long-term care partnership policy can keep most, sometimes all, of their assets and still apply for Medicaid. They can protect an amount of assets equal to whatever their long-term care partnership policy paid in benefits. Let's do a side-by-side comparison of a traditional long-term care insurance policy and a long-term care partnership policy. With a traditional long-term care insurance policy, when you need care, you'll use the policy's benefits first. If you exhaust the policy's benefits, then you'll have to use your own assets to pay for your care. If you need care for a long period of time, you might exhaust all of your assets down to the $2,000 limit. At that point, you'll go on Medicaid, and Medicaid will pay for your care. With the long-term care partnership policy, when you need care, you'll use the policy's benefits, but for every dollar the policy pays in benefits, you'll have $1 protected from Medicaid. In other words, if you exhaust the benefits in your partnership policy, you can apply for Medicaid and retain your assets. You do not have to spend down your assets to the $2,000 limit. You can apply for Medicaid and still keep your assets. The Medicaid rules change for anyone who owns a long-term care partnership policy. Long-term care insurance policies are the same as traditional long-term care insurance policies in the most important ways. You must purchase a policy when you're still healthy enough to qualify. Long-term care partnership policies have all the consumer protections that the federal government requires for traditional long-term care insurance. When you need care, your long-term care partnership policy will pay benefits exactly like traditional long-term care insurance. You can use the policy's benefits for care at home, assisted living facilities, nursing homes, memory care facilities, etc. The premiums can be tax deductible depending on your situation, and the benefits you receive from the policy are tax-free. Lastly, every long-term care insurance policy can have some type of inflation protection in it so that your policy benefits can try to keep pace with the increasing cost of care. Partnership policies must have the inflation protection. The only difference between the traditional long-term care insurance policy and a long-term care partnership policy is the dollar-for-dollar asset protection. Every dollar that the long-term care partnership policy pays in benefits, you're allowed to keep a dollar of assets if you ever decide to apply for Medicaid. Why are they called long-term care partnership policies? That's because they are a partnership between your state government, select insurance companies, consumers like you who want to protect their assets, and specially trained insurance agents. That last part is important because some insurance agents and some financial advisors are not able to sell long-term care partnership policies. Special training and frequent continuing education is required. Before speaking with any insurance agent or financial advisor about long-term care insurance, be sure to ask him or her if they have taken the special training required to sell long-term care partnership policies within the past 2 years. Question: how much long-term care insurance should I buy? Well, the answer is, how much of your assets do you want to protect? Buy a long-term care partnership policy that has benefits equal to the amount of assets you want to protect from Medicaid.